Liquidity literally tells you absolutely everything you need to know about the market, yet you still don't understand it. Today I'm going to teach you how the market makers literally rob the average trader by implementing these tactics. Now, trading is a tough game, and I'm sure you're tired of losing and now want to be on the winning side. So I'm going to teach you today about liquidity. Now, there are two forms of key liquidity you need to know about. One are buy stops and two are sell stops. And these market makers target two types of traders: support and resistance traders and breakout traders. So you are probably one of these right now if you're watching this video and you're new to my channel, okay? Where you're selling, they are buying, and where you are buying, they are selling, and it will stay this way until you literally cannot trade anymore. The algorithm will not change, and this is how the markets are ran. Okay, so there are two types of liquidity, and these market makers are trying to induce you into the market at the best price possible where they can buy low and sell high. Keeping this in mind up here, I want you to look at this chart here in front of you. Okay, constantly we have highs and lows put into the market. Now, a lot of you call them higher lows and higher highs, or lower lows and lower highs. These are correct terms, but there are different reasonings behind this term. Okay, so a high here, what rests above this high? These are the basics of liquidity. What rests above this high are buy stops, which target what? Breakout traders. Breakout traders see this high as resistance, and general retail see this high as resistance. So once it's broken, breakout traders want to be going long. Okay, so breakout traders are going long, and they may get lucky and take a 1-to-1, but most of them aim for a 1-2-3 or something higher. Okay, and look what happens. We trade up, we trade higher, everyone gets happy, everyone's winning. Let's trail our stop loss. We put in a low here. Okay, look where they put a low in. Put an intentional low in, and we trade higher. The average retail trader that's in from down here thinks, okay, I will trail my stop because support and resistance theory tells us this low now shouldn't break. I will trail my stop up to this low, and then look what happens. The algorithm tags sell stops. So these early buyers are tricked into the market, are in the market, and then get taken out because we sweep a low where they've trailed their stop loss. Who else gets put into the market? Think about who get put in over here. The sellout traders, okay? The breakout traders who are trying to go short. They see this low tagged. They see it tagged and they go short here. Where does their stop loss go? Above the recent high, right? Because that shouldn't be broken. That's resistance, isn't it? Especially with a high next to it. And then price runs up and takes them out. Now both participants have been taken out of the market. So sellers and buyers are out of the market, and where does the algorithm deliver to? The upside. The algorithm climbs higher, rebalancing imbalances, rebalances, climbs higher, rebalances, climbs higher, and whilst it does so, we tag sell stops along the way. So we are in a buy program and we're tagging sell stops along the way to induce sellers and get rid of early buyers. Now, some would say this is a pretty evil tactic, if you want to use that word, and I would agree with that. If you are intentionally inducing sellers into the market just for a better price on what you own, then I would call that pretty evil. And this is what they're doing. This is why you lose all the time. This is why when you trail your stop loss, it always gets tagged. We enter programs, okay? The algorithm enters programs. Here is a buy program. In buy programs, every tag on a short-term low is a buying opportunity. And then when we enter a sell program, every high that is tagged is a selling opportunity. Start viewing the market in this sense, and I guarantee your trading will change. Look at this, okay? As we're climbing up, there are no sell stops taken. Now let's go on to a lower time frame and see if this is the case as well. As we enter a daily buy program, look what happens, okay? Every time, I just want you to understand basic liquidity concepts from this video, okay? What we're trying to do when we enter a buy program, we are trying to get rid of as many early buyers as possible, and they're trying to induce as many early sellers as possible. Why? so that they can buy it back from them at a low price. Okay, so they are buying these stops here at a fair price of fair value and then offloading it above highs where people are selling. Okay, so they are offloading at a good price. Okay, or buying, sorry. They're offloading as we go up and at a good price where they have previously bought for a low price. Other people are buying up here, that's when they're selling. Okay, so as we're climbing up, look what we do. We go down and offer fair value. We offer fair value by dropping lower. We climb up, and then what do? We offer fair value again by creating a range, trading down, and then trading higher. All of this outlined by the grey box, that is inducing sellers, because look what we're trading below. Notice how we never actually break the trend of going upwards with these drops. We're still going upwards, aren't we? If you drew a curve along here, this would be bullish. Yet with these, we have these huge repricing drops. That is to take everyone out who is trailing their stop as we're moving up, okay? Or to rebalance imbalances, or do the same thing, okay? We have an imbalance there, as you can see. That's the top of the imbalance. We trade into it with the drop, move higher. We have an imbalance here. What happens? Well, we trade into the top of it and move higher. At the same time, we are trading below old lows. People think their stop losses are safe below these lows because look, drop down, moved up. That's a high low, right? Higher low, and then it gets tagged. We move lower to rebalance an imbalance at a discount price, so the institutions are allowed to buy at fair value. Then we start to move higher. We rebalance imbalances along the way and tag sell stops. Now this continues to happen, and I'll show you a perfect example of when it happens intraday. Okay, so let's zoom into this bit of price action. Intraday trading. How do institutions get in the best fair value positions intraday? Let's test that out, shall we? Let's dive into this bit of price action here. Remember, this red line is our imbalance on the daily chart. New York midnight open opens up, which signifies our new day. We trade lower and then trade higher. Think about what we're doing here. We've tagged sellers into the market and then we've tagged buyers into the market. Then the algorithm reprices down quickly towards the fair value gap because both participants of the markets are involved. There's sellers and there's buyers. They both get punished, okay? People who are selling, where are their stops above this high? People who have bought, haven't took profit yet, their stops below this low, and they both get taken out on the market. Now we're at a discount and we're in a discount fair value gap on the daily chart. Look what happens now. Now that both participants have been taken out of the market, look where we reprice to. Shoots up higher, rebalances an imbalance, shoots higher, rebalances an imbalance, and then we get a huge candle all above this resting liquidity where who is selling from here? Who is trailing their stop loss? The stop losses are all above these highs. Those who have gone short and rode it down get taken out of the market. And now buyers are induced. We ride a consolidation, we go up, and then look what happens. Buyers are still in from down here, remember why? Because we broke above highs and then we get a drop. Notice how it doesn't really move from this low all along here from when they bought, because they're buying at a high price. Institutions want to buy at a low price. Look what happens now. Okay, extended consolidation, drop, moves up, drop, more manipulation, drops once again, clearing up all of this liquidity. And now we can finally move higher when everyone else is out of the market. This is how the algorithm works, and I hope you learned something from it. If you did, please do drop a like and a comment. If you want more videos on this specific topic, it is a deep one, so I can dive deeper into this. And as I said, if you enjoyed, please drop a like, subscribe if you're new, and I will catch you in the next one. Thank you as always for watching.